So Mark is going to talk to us today about using these private banks or infinite banks as college planning vehicles. Okay. So there's lots of different ways to come at this, and Mark is going to shed some light on this for us. And this is also, there's a lot of benefit to this, especially if you're in the college planning industry and we start talking about FAFSA and all that kind of stuff. So we're going to go a little bit deep dive into that for you guys. And Mark is going to enlighten us. So Mark Creighton, he's a fan favorite here, obviously, as you can see from Betsy Barr. And Mark is, for Symmetry, Mark is an incredibly supportive asset for us at Symmetry. He has taught us a lot of technique, a lot of thought processes, given us a lot of options, and is well, thank you publicly, Mark. Thank you for supporting us the way that you do. We appreciate you, sir. All right. So without further ado, I've talked enough. I'm going to be quiet for a moment, and I'm going to let Mark Creighton enlighten us. Thank you, Mark Creighton.
Hey, thanks for having me as always. And publicly, glad to be a part of what you guys do. You guys keep doing what you do, and we'll have a lot of fun. Correction, Scott.
I'm sorry.
It's not when the money leaves mutual trust that we don't care. We don't care when you ask for it, why you're asking for it.
There you go.
It's your money.
There you go.
We don't ask why you want a loan. It doesn't matter to us. You choose what you're doing with it.
Yep.
So there's something Scott said there's a lot of stuff Scott said that's excellent. And to answer a question earlier, it's we're addressing two issues. When you're talking to clients about DFL, you're talking about their debt. And the two questions that engaged that client to you were, are you 100% sure of your retirement, or do you have doubts? If I could show you how to get out of debt in 9.5 years or less, would you be interested? They said yes. They said yes. You engaged them. So that first question is key. How do we retire? There's not a magic button. Sure, you can go roll your dice in the stock market. You can go find the next crypto. You can try all those things, but how successful are you going to be? Maybe you get lucky. Maybe you found Google when you needed to find Google, or Apple or Tesla or any of those. For every one that did, there's a million who didn't, and they're still struggling. In all of those cases, you're putting all the risk, or you're assuming all the risk. This plan that Scott put in front of you, there's no risk involved. The risk is all on the carrier part, and we have no risk because we do what we do well. We've been around for 100, 200 years, a really long time. We do things in such a way to protect all of our clients' interests, to meet our obligations now and in the future. Your plan, that DFL plan, is the backbone of a future financial plan. It's one that if you stay disciplined, and your client needs to be disciplined. Hey, there's people out there who will consolidate debts for you, and I've got relief. I don't have to pay as much anymore. Guess what happens to the majority of them? They fall off. I got another credit card. I'm going to go ring up debt. Now they got to go consolidate again. And pretty soon they're SOL. Pardon my French.
They're on the hamster wheel.
It does not work, right? This is a plan that works. And if your client's disciplined, they're going to have that 1.5 million that allows them to retire 20 years earlier than they want to. Or what's true retirement? Hey, I don't have to do this job anymore for a paycheck that I need this paycheck. I'm going to go choose a passion. I'm going to go take a 80% pay cut and go do something because I don't need those dollars. I get to go enjoy my life how I want to work. I'm going to work part-time. I'm going to go volunteer. I can do whatever I want. But it's about discipline. So when you have that freedom, remember, there's a certain guy, his name might be Dave Ramsey, it might not be, but he tells you to.
I think it's Rave Damsey is the guy. Rave Damsey.
Rave Damsey. That's
right.
It.
That's
I
him.
wasn't trying to say his name. You just gave it away.
Rave Damsey.
He tells you to change your lifestyle. Stop going out. No more movies. Cut cable. Dumb down your cell phone plan. Get rid of your cell phones. Buy the cheapest car you can. Eat pork and beans. Change your lifestyle. Scott's helping you do this, and he said, don't change your lifestyle. I'm going to change your fortune. And we're going to do this just reallocating and being smarter how we use our money. And if you want to retire, Robert Kiyosaki says, now how much you make, it's how much you save and how hard it works for you, right? So I don't want to go chase interest rates. I don't want to go chase returns in the market. I don't want to worry about, hey, I'm nearing retirement, and if another 2008 comes and I'm about to cash out of my 401k, now what? No, I don't want to worry about any of that. I want to put my money away like our grandparents did and save, secure things that are going to grow. The best way to grow your wealth is put it in something. Put it in something solid that's going to be there. All right, off my soapbox. All right, so IBC, I love IBC. Been doing IBC for a really long time, personally, professionally. Stood on stage at the Nelson Nash think tank. I didn't see who did it. Somebody threw out the Warehouse of Wealth link. Nicely done, out of the Nelson Nash world. Stood on stage talking about this for a long time. We're a carrier that loves it. We're a carrier that's embraced it from the beginning. And infinite banking is just the freedom of having capital that's secure, safe, grows when you use it, and you decide how, when, what you do with it. And you decide when you pay it back, how you pay it back. You decide what you're investing with, what you're doing with it. I'm going to tie that in to some college planning. So as I'm creating a plan for myself, hey, congratulations, you don't have debt. Scott, where do you store your opportunity money?
And that's safe right over there.
That's safe. Great. Scott, when you use it, when you take it out of the safe and go spend it, what does it do for you?
It leaves my safe and goes away forever.
It's still going to grow there, right? Oh, wait, it's not even growing in there, is it?
That's mold.
Oh, man. All right. What if I could show you a different place to put your opportunity money where it's going to grow? Tax deferred, right? We're talking about IBC, and this is a beautiful thing. So let's think about our clients, and this may be your debt clients too. You can wrap this conversation in. We're going to help you get out of debt, and we're going to help you afford your kids' college education. Okay, so we're building cash value in these plans. We're saving money. We're getting rid of debt. I've got more money. I'm going to be able to give my kids the college education we want, because that's all our dream, right? We don't know how we're going to meet.
You know, I'm doing that already. I'm doing that with the 529 plan.
Yeah. Oh, but a 529 plan. Any of your kids, are all your kids dead set on what they're going to do? Might their minds change?
They're going to do what I want them to do. They're going to go to college.
Okay. What if they don't? Does that happen?
Yeah. Yeah. Joey wants to be a chef.
What flexibility do you have with your 529 plans then, Scott?
Well, you know what? That's funny you should say that, because I was looking at my 529 for Joey. And it's a good thing he's not going to doesn't want to go to college at this point, because it actually lost money last year.
Ooh, that's hard to plan then.
Yeah, that's rough. So I didn't know a 529 plan was invested in the market.
They can be. Absolutely. Yeah. And when you use that, it's growing tax deferred for you if it's growing, right? Presumably it was supposed to grow every year.
Yeah.
Okay. When you use it, are you going to have to pay some taxes?
I never thought about
that. So it's a great vehicle. Hey, congratulations. I'm glad you were thinking ahead. But there's a better way to do this. And there's a way to do this that gives you the freedom to pivot if you have to pivot. Now, Junior over here, Junior was great in school. He got a full ride somewhere. He's a great athlete, scholarship for athletics, scholarship for academics, whatever it is. College just got a lot cheaper for him.
Chess club.
Love it. That 529 plan, what are you going to do with it? It doesn't do anything for you. But hey, this plan I have over here, you don't need to use it for college? Great. Now it's just yours to use for what you want to use it for. Use it for the other kids. Flexibility. And we're talking about IBC. We're talking about whole life insurance and the idea of funneling that money. Hey, we built a plan to get you out of debt. It's building cash values. You've been repurposing that saved money into building wealth for yourself. Now this is money that's going to help you pay for college. It gives you that freedom. You don't have to saddle your kids with millions of dollars of debts, or you can help them pay it off. You've got the flexibility in doing that. So there's there's a marketing piece I'll share at the end of this that kind of talks generally about this, but I'm going to share two different ways to build this. Scott, can I share?
Yes.
You disabled me.
I just enabled you.
There we go. All right, see if I can do this right. And
Yay!
here we go. Rise of Value.
I know that program.
It's a good program. Rise of Value is our cash rich policy that gives you all the flexibility in how you want to design with those term riders and paid up edition riders Scott was talking about earlier. Just did something here. 38-year-old planning ahead, or maybe they were getting out of debt, whatever it is.
Mark, I got a question for you. Can you see my software?
I'm sorry?
Can you see my client software on my computer?
No, is this your client?
This is exactly what I did not an hour ago. 38 years old, college funding strategy, exactly $1,000 a month, exactly. Okay.
I'm smart like that. And I swear we didn't talk because I was with my mom at a doctor's appointment before that. This is all completely random or two really aerodynamic guys thinking alike.
There you go.
All right. So we've got $1,000 a month that we're going to put away, or we were using to get out of debt. Doesn't matter. He was building cash value. And we went pretty aggressive with this. We wanted a little bit of death benefit, protect the family. So we've got about $250,000 of death benefit instantly, which is, hey, nice thing to have, protection. Of my 1,750 is going towards cash, immediate cash.
Can I make a
something
comment?
he can use?
This is a 75% cash efficient program.
Mm-hmm.
There you go.
And I threw a little bit of term on there. I threw 100,000. Hey, we've got a little bit extra room. We can throw another $780 a year. That $100,000 term rider, that's my lever. I push and pull it to get this policy to do what I want. I can set it at 75% efficiency, but allow him to put in more later. I like to be careful in that. If they're really never going to do it, don't crank it up too high. You're wasting money on term insurance that's not going to be utilized properly. I'm going to advance down. That's how we built it. Let's take a look at what we got. So our 38-year-old guy has an 8-year-old child. So he's looking at college about 10 years out. Get him in college, 12 years out, 13 years, between years 8 and 12, he may start to think about how I can use the policy. He may decide, hey, we can get through college now and I don't have to pay anything out of pocket. We can do it through loans, whatever. I'm going to take a couple loans. I don't have to pay anything on it. Maybe that's the strategy that works best for them. Maybe they can start drawing out of the policy now, borrowing out of the policy to pay for those tuition bills as they come. They've got the flexibility to decide what's going to work best. And that's what IBC, that's what these policies allow clients. And now I'm looking over here because I just moved everybody's face. Sorry. These policies allow clients the freedom to choose what makes the most sense because it's their money. They decide. So along the way, we start building cash value. In year one, hey, child's 9 years old now, but I've got $8,000. Is there something I can do with $8,000? If there is, great. Use it. Pay it back. The money's in the policy. The money's going to continue to build. This
Disney
guaranteed. Go to Disney World. These guaranteed values are going to occur whether you use the money or not. The only thing that can change those values is, did you pay $12,000? If you threw in some extra bucks, those numbers are higher. If you took out some money, those numbers would be a little lower. You control what that guarantee is. The client does. We don't. No matter what I say, I cannot make that number different. No matter what anybody in the company, our CEO can't change it. Our actuaries can't change it. It's a contract. It's enforceable by law. So I've got 51,000 accumulated over 5 years. Do I have use for that? Sure. Hey, I needed a car. I'm going to buy a car. I'm going to pay it back because in 5 years, when that car's paid off, my kid's ready for school and all that money is still in there and I can use it. Accumulated 112,000 over a 10-year period.
I'd like to point out that you're only using the minimums and the
only using numbers. The minimums.
Right.
Only the minimums and only the guarantees, because that's the power. We talk about other plans and other things that will work. Sure, that's great. I can sell you the right side of an illustration all day long. We're coming out with an IUL. I have nothing against IUL, but the right side of a ledger is predicated on something that's not going to happen. You are not going to get the same return every single year. Zeros will happen, and when they happen, where they happen, will determine exactly what that future number is going to be.
Can we dive a little bit deeper into that? Because there's this big conversation about IULs. So if we know that in a 10-year period on an IUL, we're going to have at least 2 years of zero growth, which is really, that's kind of conservative. Okay. But if those 2 years happen in the beginning, that destroys the entire long-term performance on an IUL.
Yeah. If you're buying one right now, be ready. It's not going to project the way you think it is.
Right.
We're in a really weird space.
Yep.
So this is a plan for somebody that I would consider to be long-term planning for their clients, that their kid's not ready to go to school yet. They're not a year, 2 years away. They're 10 years, 6 years, whatever it is. They've got some time to build some cash values. So we're going to do it where this cash value is growing tax deferred, because all whole life sales, both these solutions I'm going to show you, cash value grows tax deferred. It's accessing it. There's a difference. This, we've abided by the IRS's rules. This is not a modified endowment contract. So I have the ability to use what I put in and its gain. I don't have to pay taxes on it. Beautiful plan. And there's flexibility in this design. Hey, I'm doing this because I also need to think about my retirement. So I've got a way to figure out how to get my kids into school and create some of my own retirement money. I've got a way to get out of debt, get my kids through school, and have a retirement. This is a Swiss Army knife. You can use it for whatever you want. I'm a small business owner. I've got a way to fund purchases for my small business owners, get me out of personal debt, fund my kids' college, and fund my retirement. All these things can be done with this plan. You control the cash value. You don't need it yet. Just make sure you put it back. You want 112,000 10 years later when your kid's a freshman in college, you've got to respect it and you've got to put it back, but you can use it in between there. That 12,000 is flexible. Let's say in years 11, 12, 13, 14, junior just left for school. I am going to reallocate some of my $12,000. I'm going to reallocate $9,000 per year because that's the PUA amount. I can reallocate $9,000 a month, a year. I can use that for tuition. I'm saving it anyway. I'm going to leave my plan alone. I'm just going to take the $9,000, pay tuition. Guess what? You've got the freedom to decide that's what works best for you. Your choice, your plan. Any questions on the long term yet? Because we're going to jump into what do I do if my client has a kid who's going away to school in a year? Well, there's not much you can do.
Before you go away for a year, couldn't you get a student loan for the number of years that the kid's going to be in school? That's deferred payment, and then
absolutely
borrow from your policy to pay it back.
That's another strategy, Lorraine. Yeah. So in that scenario, you're going to go ahead and get a student loan normally, but instead of deferring it, you're going to start paying on it immediately. And you would use, and this, what Mark's got up on the screen right now, you just use a drip campaign to take out $300, $500, $700, whatever per month, and actually throw it at that student loan so that by the time your child graduates in 4 years, they're not left with a $90,000 bill. They're down to something that's very manageable. And it's something that, or maybe even just paid off. So that's definitely a strategy. That's which I love. But
Hey, Lorraine, a great question. And you know what? I did that with my daughter, and there was a performance bonus clause. She performs well in school, better things happen to how I handled it.
nice.
Bribery works.
And she's a bright student, so I knew I was out of the money right away. So I really didn't offer anything I was prepared for. and but it was a great plan and a way to keep her motivated and get her through school and as fast a time as possible.
Can I address one thing that Lorene asked real quick?
Yeah.
Just did 2 financial aid forms for my kids, last 2 kids to go to college.
Oh, you're gonna steal my thunder.
Yes, he is.
We got to.
Oh man, that. Are you really gonna do it, Tom? Go ahead. Go ahead.
Okay, I won't. Then I'll hold off. You know what I'm talking about. Then
I do.
as long as you promise to cover it. But Lorene asked, so
I'm gonna slam it. Mic drop it. All right, so let's take a look at our next plan here. Okay, so oftentimes you're going to run into clients. They've got sophomore, junior, senior in college. That $1,000 a month isn't going to get them very far, right? That it's a little too late to start saving, but maybe they've got an asset, and that asset is somewhere liquid. They don't plan it, they set it aside for retirement. Maybe they set it aside because that's what they were going to use to pay for college. So it may be in a CD that they're rolling over. It may be in a bank account, money market account. It's somewhere, right? And Tom, I'm going to ask you because it's right where we're going. If your client's holding money in an asset like that, what's one of the weaknesses? What's one of the problems with having an asset? Congratulations, you did great. So smart, so diligent of you to prepare for school. You're facing a problem. Tom, what is that problem? Tell me.
you mean an asset like a 529 plan, for example?
529 plan, money in a savings account, money in a CD, an annuity, not an annuity, a CD. What's the problem with that?
There's a line on the FAFSA form that asks you what your net asset value is. Basically what your net worth is.
So I would have to disclose that I own that?
Yep, because that's a value, that's an asset.
And what will they do to me if I have that?
They take that into consideration when they're offering you some financial aid. And let's just say it doesn't help.
It's called EFC, expected family contribution. They see you have money. They expect you to spend it on tuition. That means they're not going to help your child as much as you'd like them to. But Tom, what if I put it in a whole life insurance policy?
You get to tell your children, or you ask your children, can you put a negative number in that blank? And when they tell you no, you say, then put 0. And then you have to explain to your kids that you've protected all of your assets in this way, and your mortgage and everything else makes it a negative number.
Exactly. So no matter the plan, our long-term plan, hey, I accumulated 119,000 at the end of 10 years. That's not on the FAFSA plan. You were shoving that in a safe place, a liquid place, like a 529 plan. You were putting in a money market account. You've got to tell people you have it. It's going to work against you. Here, it doesn't exist. What does that mean? When it comes financial aid time, more need-based aid, more aid for you as a whole. So our client here is closer to college year, and they've accumulated an asset. And this strategy is explaining to the client, hey, we're going to take it from this financial institution and we're going to move it over to another financial institution. It's going to give you the guarantees, access, and liquidity that you currently have. We are going to give up a sliver of access to the money for a few years. We're going to do that because in exchange, you'll have a lower EFC, expected family contribution, more potential financial aid given to your child. And oh, by the way, we just put $300,000 in place that should cover college at least one semester now. That's the going rate, right?
Unless you're in
I
community.
structured this plan, and I added a little thing to it that some plans I see have it, some plans I see don't. We had $100,000 sitting somewhere. We're going to roll it into this whole life plan. This is a modified endowment contract. I want immediate liquidity. I want break even as fast as possible because I want my client to feel secure that this move is going to work. So I've got a $2,000 insurance premium. Of the 100, I'm using 2. Be honest with you, I want to pay you for your efforts, your servicing. You need to make a living. 2,000 is buying that. Also provide some additional death benefit. 2,000 goes into that. 98,000 is going into a single paid up addition rider. Here's a note. This is a single premium type sale. I don't use our single premium product for college funding. You cannot withdraw out of a true single premium product. Not ours, not anybody's. Use the horizon value, use the chassis of that product, you put the money in a single paid up addition rider. I also threw $100 into the flexible PUA rider, and I added a maximum of $10,000 that they contribute, just in case they trip over money along the way. They've got the ability to put some extra money in here that they can use, that they can grow, that they can use for retirement, whatever it is they want to do. They've got the ability to fund this further. Or maybe they're looking at kid number 1 going into college, but you know what? Kid number 2, 3, and 4 are on their way following them. I need to create more savings to get my kids through school. I like this. It's invisible on the FAFSA report. This is where I'm going to start throwing money. Take a look at the ledger.
Mark,
Yep.
Before you go past that page. So you're saying you put 98 into a single paid up addition rider. Is that right? Did I catch that?
Correct.
98,000?
Correct.
And you're still putting 2,000 a month, but
Annually.
you're only putting 100 into the PUA.
98 into the flex PUA, $100 into the flex.
Total per year. Right?
Yep. But I'm allowing them a max of 10,000. Oop, just lost my drawer.
This is an annual
10,000
premium.
additional? Is that 10,000 additional?
10,000
Per
additional
year.
Okay. All right.
per year.
Okay.
And the plan can have it, can not have it. Maybe they want to put in more, so I bump it up to 20. Maybe they're never going to put it in, so I just leave it off.
Okay. All right. Got
It's
it.
just a kind of a bell and a whistle I threw in here just for a talking point.
Okay. So I have a
Sorry,
question
interrupt-
because my brain just exploded. Okay.
Yeah, really.
Yeah, that's let me backtrack. So I got this asset. We're intentionally meching it in a single premium with the sole purpose of not saving money on taxes for the growth of the money, but for protecting it from the evil financial aid foreign people. I'm just making sure.
Pretty much.
Okay, I'm on board. My brain skipped a track when you said intentionally meching, because of course we're trained never to mech, but this is a good thing. They don't care about the taxes. They're doing it for a different reason.
Hey, Tom,
Yes.
Advanced Markets Workshop, meching is not a 4-letter word.
Right.
I
Wow.
understand. I
who
was
came up with
I
but it's been drilled in my head. Okay.
know.
I'm still working on it.
We've got the mallet out, Tom. We're trying to bang it out of your head.
Okay. Well, my head just exploded, so it's a lot easier.
Okay.
Okay. I got you. I'm with you. Thank you.
So, and I apologize. Forgive me, everybody. I set this up intentionally to be a single premium where they didn't put anything else in. I forgot to hit the little button. I was in a hurry when I was doing this early this morning. Here we are presuming that they do pay $2,000 a year, but they don't have to. We can set it up where they don't pay it, but they're paying $2,000 a year. So my cash accumulations are based on that outlay. But look at the liquidity in the plan. In year 5, they're out of school. We just took the 100,000. We gave up a little bit of access. 100,000 in. Hey, year 1, you've only got $93,600. I rounded up by 7. Forgive me, everybody. I've got 93,600 there. I'm giving up a little bit of access. If I tell you, give up access to 6,300 today, and I can turn that into $14,000 a year in additional financial aid, are you game, Tom? Right. So that's the hook. So I don't want you to give up $70,000 because I better make sure I can absolutely save you. I better get your kid through college for free if I'm going to do that to you. I'm not doing that. I'm saying I just need a little bit of your money to make this work. And in turn, look at how it grows. On a non-guaranteed basis, adding the dividends, client's whole and has $344 of gain in year 4.
No,
And in
the client's whole and has $1,700 in gain in year 2.4.
Yeah, this is assuming I paid 2,000 extra, so I had it's a running number. So that's year 4 is 106 of outlay.
Okay.
Or if you add in the financial aid that they got, it's actually a bigger return.
It's a way better.
It's a huge return. For these clients, this is not about striking it rich. It's not about turning 100 into 400,000. This is about reallocating. It is about moving money, moving an asset to get it off the financial aid form where your return is going to be based on what you don't have to spend in college. When we went through DFL, and to tie this in back to DFL for a minute, the return on a whole life policy is the sexiest thing in the world, only because it's stable and guaranteed, but it's never going to wow anybody. It's never going to rival what anybody's gotten out of Tesla who invested at the right time. Never will.
I think it's going to wow anybody who got money invested in the market last year.
Yeah. But where is the return in a DFL plan, Scott?
Where is the return?
Where's the biggest return?
But I mean, this is compounded interest, so it happens at the end of the run is where you're going to see the biggest return.
Is the return of $70,000 of interest you don't have to pay something that should be considered when you look at how a DFL is performing?
Hold on one second. I'm doing some math. It's actually the equivalent of $96,000 of income.
No,
if it were taxed.
Mark, I'll buy it. Yes, that is amazing, and that is where the return is. It's not just the actual numbers that you see, but it's the intangibles outside of it, the interest that you're not paying, the weight that is lifted off of people because they're out of debt. And I mean, look at this. That financial aid letter that people are going to get that says, here's how much you can receive in grants and scholarships. That is the return on this. And that is powerful and it's amazing. And Mark, you're the best. So
wait, it's my turn. Betsy Barr. Woo, woo.
Woo, woo, that's right.
I've never done that on a call. And yeah,
you're on camera, buddy.
Jump on in. The water is fine.
Are you still recording?
Oh, yeah.
Dang it. Keep this away from Mr. Suquette, please.
Yeah, I'll see him in a couple weeks.
All right. So there's a couple of things you got to know about this. So this is short-term college planning. There are the IRS or the financial aid people do have some limits on this. There's a time frame they have to do that, and I believe it's by the end of the end of the calendar year during the child's senior year of high school. If the money's moved in after that, I don't know that it's invisible on the FAFSA form. So check that out. Do work through, understand the financial aid form, but this is absolutely a strategy that can work. It's not anything you have to go out and practice, but hey, what have I learned Symmetry does for you when they're bringing you up and teaching you the business? It's how many opportunities do you have? Know what's available to you. This is now an arrow in your quiver that when you're meeting with the family and you get to know that they've got all these little rugrats over here and they need, you know, that what keeps them up at night is how are they going to pay for college? Or you know that they've got a sophomore in college, a junior in college, and they're going to need to think about this. This is something you say, oh, I saw this over here, because you got that data form that tells you everything about them. This is something else that you can say, hey, by the way, we were working on this, but I noticed this and I've got a solution for you. It endears them to you further. It's one more reason why that client is always going to go back to you and never leave you, which is what you want in this world.
Mark,
yeah,
we're getting close. We're a little bit over.
Yeah. Oh, there we go. There we go. There's our marketing piece. This is available at the agent website. Under the Agent Resource Center, under Marketing Materials, the 5th tab all the way on the bottom, just click Marketing Materials. This is under Client Solutions. College funding solution. It talks a little bit about the long-term and short-term. Talks about the financial aid and that it's an invisible asset. Growth, access to funds guaranteed. In the event of the worst, guess what? That client had $300,000 to take care of college, the house, whatever for the family. This was never about death benefit, but guess what? It's an insurance policy, and insurance policies are the best. So do go check it out. And there's a cool little chart here that helps you. College savings plans. Oh, tax for growth. That's nice. Many interest-bearing accounts. Bad. Okay. Bad. Okay. Bad, bad. Variable growth. All the risk is on you. Maybe you can't send your kid to college, but do check out that piece. Thank you for time. I'll do what Donna tells me to do. I'm going to be quiet now.
All right, Mark, you can stop sharing your screen.
All right. I don't know how to do that. Where did it go? Stop. There we go.
All right. So all right, guys, we're about 10 minutes over. Let's go 5 more minutes for those of you that are still here. Faith, Deal, your hand is still up. Do you have a question?
Her arm's got to be tired because it's
Yeah.
been up for a long time.
Faith Deal does not. She will unraise her hand. Thank
All right,
you.
Benjamin Johnson is my next. Benjamin?
Hi, thanks. This was really great. And I'm missing some pieces in my visualization of what this process might look like. And I popped them in the chat there. So what are the most common types of assets that you see clients moving money out of into this? And like if it's a 529, if they move that out and they're not paying that directly for education, there are taxation considerations.
If they liquidate a 529 and don't use it for education, they're paying tax.
So you just have that conversation and show still the value proposition potentially of the increased financial aid.
You never,
potentially
just
outweighs
so we're on the
that.
same page. We never said move money from any kind of retirement program or 529 into this. We never said that. Okay, because we're not trying to create a taxable event. What we are saying is, okay, well, if you're putting that money into a 529, it would be better spent here. Okay, if you've got $100,000 that you're going to have to record on your form to qualify because it's sitting in your savings account, checking account, money market, move it into here. Okay, and that gets it off the books. That's what we're saying. If I missed something, please speak up.
So that answered my so I guess my number one question there is, you're talking primarily about assets that are not going to trigger a tax event to roll into the single premium.
Right. We're talking about getting assets off your books that are going to cause a problem with financial aid. and qualifications for support. That's what we're trying to do here.
Thank you.
Deutsch,
Tasha Sims was in line ahead of me.
Tasha. Hi, Tasha.
Hi. So I had a question about nonprofits. So if it is a situation where it's like a homeschool, if they want to, can they use this so that they can pull funding for things they need for the school? So they're listed as a nonprofit. So basically use the head of the school, like almost kind of like the principal role, have them be the owner and the insured. And can they then, would there be any taxes? I just don't know how to structure that if it's you know, a nonprofit and it's listed as a school. Is that something that is possible?
I can take it, or you can take it, Mark.
I got it.
Okay.
So there's a lot of advantages in working with a nonprofit. One, we don't have to abide by the IRS's rules because they've got some exemptions from taxation. So you've got more flexibility in how you design stuff. And in some ways, that's really a good thing. The biggest problem from an insurance carrier's perspective that we have in that is what you were just discussing. So and like a church. We want to put 17 million churches flush with money. They have, you know, they have great parishioners. Everybody's tithing 20%. They're flush with money. We want to buy a policy on the pastor as a key person. Qualify. It qualifies as a key person. Absolutely. Death benefit by a carrier is issued based on income. So we're going to look at that individual's income and use that to equate how big of a policy they could have. It could absolutely be done, but under, you know, they've got hundreds of thousands of dollars and you want to put it in, it's not going to work. We're going to hit the line of what we can do.
Mark?
If they've got,
Pastor, associate pastor, deacon. Doesn't have to
you
be
can do it
program.
right, but it's going to be relative to income. And once you get to the deacons, though, you know, what's their income? Pastors, we do it all the time.
So it could be another key person within the admin who had a higher annual revenue. Okay.
Good. Yeah. Just when you're getting a case like that, what I would recommend, I just shared my contact information. Call and we can discuss. I can walk through the details, get the details of, you know, what they've got from a cash flow standpoint to fund the plan. And then let's talk about who we can insure, how much we can insure them for, how we're going to structure it. And then, you know, regarding your question, can they use the money for school? Yeah, they can. We don't care.
Right.
Once it's in the plan, we don't care why they use it. Yes, they can absolutely do that.
Okay. All right. Thank you.
I'll make this real quick, Scott, because I know we're over time. Okay, Mark. First of all, for the field on that last comment, the key person insurance, Mutual Trust is one of the only companies we can work with and do this and do a key person on. One of the other companies doesn't do that anymore. Just so you know. I know we're not supposed to talk about other companies, but they don't. So Mark, help me follow this all the way through. So I got $100,000. I got a kid who's going to college. I buy a single premium. I make sure I do it well in advance of the deadline of the money not appearing on the FAFSA form. I get as much debt as I can through the student loans. When it comes time to pay that off, I can either access it like a debt-free life bank, or since it's a MEC, I can just pull the money out and pay it straight, right? I have a choice now.
Yeah, correct. And,
Okay.
and it comes down to, you know, I'm sitting with you, Tom, and I'm presenting this to you. I'm going to ask you some leading questions. And one of them is going to be, how do you plan on paying for your kids' college? What is your plan? And you may have told me, well, I've got this asset over here. When they're done with college, we're gonna roll student loans up, and then when they're done with college, I'm going to take care of those.
Gotcha.
Okay. Tom, let me show a better way to do that. We're going to move the money, and by doing this, you're going to give up a little access to it for a few years. You're going to get it back, I promise, guaranteed. And what you're going to gain is more financial aid, so you don't have to pay as much when you're done, and you got the freedom to do it.
But are you really losing access? Because I can always take a loan against it, right?
Well, first year cash value was 93.6.
Yeah, you're not getting 100% recognition.
I don't have 100% access to it, but it's not like I have 0% access to it.
Right. You just gave me, you just lost access to $6,000. The rest,
you've got
you can still
94%.
use until you're ready to use it. Yep.
So it's not like I'm putting it in Fort Knox and can't touch it for 4 years.
Hey,
exactly.
One additional digging in a little bit deeper on this, it is a mech. The way the last one restructured, right? It is a mech. However, let's assume you take all 94,000 out of your $100,000. Let's assume you take it in year one. Do you owe tax in year one?
No.
No. Do you owe tax in year two?
No.
No. When do you owe tax?
In year 3 or 4, I don't remember the chart, and you
Right.
only owe it on this much money.
Right. It's because
over
your
the initial
cost,
principal.
your cost basis is $100,000. So when the cash value exceeds $100,000, even though you've borrowed 94, whatever the delta is over your initial $100,000 is going to be your exposable, your tax exposure, and it's nothing.
So that begs
pennies.
That begs a follow-up question. Go ahead, Scott.
That's it. I just wanted to make sure people understood the process of taxation with Max.
So the cost of insurance is included in the cost basis when determining growth?
Well, I mean, all right. So $2,000 per year, $100,000 in year one on the example Mark gave means you had $98,000 as a single premium and $2,000 going to pay for the program. Your total cost in year one, your basis is $100,000. In year two, you pay another $2,000. Now your basis is $102,000. Year three, $2,000. Now your base is $104,000. So really, even in year three, you're not to the point where there's a taxable event, assuming the person is a standard rating. Okay. Yeah. If they get a substandard rating, it limits the amount of cash they're going to have available. It also pushes that taxable event further off in time.
Gotcha. So the answer is yes. The cost of insurance is considered in the cost basis when calculating your taxable event. Okay.
Everything but term premium. It's any premium that effectively will increase cash value is part of cost basis. Term premium is never.
Understood. Great. Thank you.
And Tom, that's a great point you make to consider the taxation here, because the reality is I'm probably moving an asset when I'm working with a client to do this. I'm probably moving an asset where they're already paying taxes.
Yep.
So the taxation of this is inconsequential. They're already paying taxes on this money. We're going to let it grow tax deferred for a little bit, and they only have to pay taxes on the gain, not what they put in ever.
Gotcha. Okay.
Awesome.
Really interesting stuff, Mark and Scott. Really interesting stuff.
All right. Well, Mark Creighton, thank you so much. I can't thank you enough for being here. I know a lot of people got a lot out of this, myself included. For everybody that asked questions and commented, thank you for participating. Thank you for investing time in you guys. And if you're here as a potential client, get back with whoever invited you to this. Talk to them. It's rare that I've ever seen a reason why you shouldn't do one of these programs. So, and I think you'd be hard pressed to find a reason not to. So, good luck to everybody. Go ahead, Mark.
Who's the first person you should do a program for?
Yourself.
Yeah, we'll pay you.
Yeah. And oh, by the way, for those of you that are Symmetry agents, and you are part of Mutual Trust and you've written business with Mutual Trust in 2022, you have 1 day left to submit your reimbursement.
Yeah, Mark, I had a question about that for you. I called you earlier today. Hopefully we can catch up later.
Sure. Call me right after this.
Bye, everybody. Thanks for coming.
See ya.